Well, things are getting pretty tricky during the election. This is a time where there's a lot of uncertainty in the market. And this is a time that you have to take caution in your portfolio and pick your entries into stocks and buy the dip. Tom Lee just dropped some pretty big information on the current landscape of the tailwinds that we have in the stock market right now, but also the headwinds that we face going into the election time, as well as the volatility due to the unknown. Let's take a listen to what Tom Lee had to say. Let's not worry about smashing the like button, subscribing, or looking for the Discord link just yet. Let's hear what Tom Lee has to say about the market and its current headwinds.
Speaking of equities, I'm going to do something rare, mostly because it's funny, and give you a hard time for not being bullish enough. 6 weeks ago, you warned about a potential 10% pullback in the S&P in the next 8 weeks. We're up 6.5%, I think, since then. Now, you did say to buy any dips if that were to happen, but do you see any more potential icebergs? What do you think got us this far?
Well, John, the stock market in the last 6 weeks has proven its character, which it's had all year. The S&P is incredibly strong this year. It's been up now 9 of 10 months. And you're right, we got fooled by seasonality because I figured, well, between now and Election Day, there's a heightened possibility of some type of correction. We weren't saying you want to sell stocks. I think it's always a mistake when people panic sell, because we, literally in the same paragraph said, but if it does pull back, you want to buy that dip. And I think we're still in that tricky period until after Election Day. But that doesn't mean I think investors should be bearish right now. I think we have a really good fundamental backdrop. I mean, look, if David's view is correct, 3.5% 3.5% Fed funds rate is very supportive of the economy. It's going to really take housing and autos and durables out of a recession, and that should be good for not only earnings growth, but for PE multiples. So to me, all of this, I think, is a pretty good backdrop. That doesn't mean turbulence couldn't happen. So, Jod, I guess, I think people kind of view the idea that there could be caution as like a dirty word. It shouldn't be. I mean, this is a stock market, and people should be prepared to buy dips if there are.
Yeah, and we're coming into the 2 weeks of peak earnings season, Tom, to your point. Plus, right behind that, we do have this election. So the next couple of weeks will be ones to watch here for investors. You just mentioned housing, though, Tom, and I do want to get your call on that because you're bullish on the home builders, and you say there's historical precedent for this.
Yes. The reason we highlighted the trade today is that since 1999, believe it or not, there's a 6-month window when home builders enter a golden 6-month period. It's something we've been writing about at Fundstrat for a better part of a decade, and the trade's worked 12 of the last 15 years. But from October 20th to April 29th, home builders have outperformed the S&P by an average of almost 1,900 basis points. So all of the gains home builders make typically occur those 6 months. I can't explain the seasonality, but the backdrop is better today because the Fed is cutting at a time when there's pent-up demand, and the home builders have actually done a very good job of capital management. So to us, it looks like a trade that should work this year.
So I'm going to break down everything Tom Lee said, explain to you guys what I think is likely to happen as well, and how I'm attacking these headwinds going into the election to try to figure out how to stance myself on my portfolio and what you guys should be looking to do as well. However, first, before we do that, if you guys are looking to retire early or just grow your portfolio and have financial freedom, maybe you're having difficulty in the market, maybe you're just having a rough time and you want to learn quicker and more efficiently, I'd love to help you guys out. We have very limited spots in the Discord right now. I had to take a week off without being able to bring anyone in. We had to close registrations, but now they're open again. So if you guys would like to join in and take part in my one-on-one coaching, Discord, and full training course so you can take care of your financial freedom, I would love to help you guys out. As long as you guys show up dedicated and eager to learn, I will show up dedicated to teach you how to grow your portfolio. So you can go to investwithcorey.com. The link's in the information box below. You guys can go to the testimonials to see what my current students are saying. Sherry took her $8,000 portfolio Now it's at $22,000 in just 3.5 months. Josh is up $90,000 in just over 3 months. You guys can then click on training, and any questions you may have will be answered right here in this video, as I don't have time to answer them right now. But if you click this video, then you'll be able to book a call with my team and I. This way we can build a system that works just for you. I look forward to seeing you very soon when you're ready to join and take control of your financial freedom. So Tom Lee said that the S&P is very strong, which it is. It's up 9 out of the last 10 months, August being a really rough month, and we had some rough patches in September as well, but overall, very strong. We also have some headwinds, which is really the unknown, the elections. And really, we shouldn't be panic selling, but definitely buying the dip, which is why I have a cash position in my account, a pretty big size cash position. And I sold off of stocks at peaks, took profits on stocks that were unlikely to move much, at least until after elections. This way, I had more capital to invest in stocks and buying dips. There's a lot of this going to be happening in the next 2 to 3 weeks. It's a pretty volatile market. I'm not bearish on the market, just like Tom Lee said. I'm actually a little bit more bullish than most, but there are going to be some dips and there's a lot of unknowns. And the closer we get to elections, it would actually be better if a candidate was a little bit more likely to win. If a lot of news agencies start reporting one candidate is more likely to win and it's more, not concrete, but more, I guess you could say conclusive or more highly probable, the more we go into that direction, that's better for the market because the market will start pricing that in. The issue is, if the news agencies start saying it's 50-50, no one knows who's going to win, anything of unknown, being unsure, or 50-50, or a tie, or it's going to be a very close race, that's going to create volatility in the market. So you want to watch out on the news for hearing things like tie or deadlock or even, or things like unsure who the candidate's going to be, too close to call. Any statements like this over and over again in the news is going to incite uncertainty in the market. It's not good. What we should be hearing if we want good results in the stock market is there's a clear lead, a clear winner, or likely to win, or this candidate is more likely to win, or it's looking like this candidate is more and more likely to win as time goes on and we get closer to elections. More of a bias. If we're hearing a bias of who's likely to win, the stronger that bias, the better it will be for the stock market. The more of a deadlock or a tie or uncertainty of who's going to win the election, the more volatility the market will have leading up to elections. The Feds are also looking to cut rates at either 25 or 50 more basis points potentially by January. If that happens, it'll bring us down to the 4% Fed rate. And Tom Lee talked about a 3.5% Fed rate, which is likely to happen by near the end of 2025. We're supposed to get 25 to 50 basis points by January, and we're supposed to get another 50 basis points in 2025. So if we get 50 basis points between now and January somewhere, then that means that as we go through 2025, we will get closer to that 3.5%. This is really good for auto, housing, and durables, and will pull them out of a recession, like Tom Lee said. But it's also going to help earnings across the board because companies are going to be able to make more money if money is cheaper to borrow or cheaper to acquire with a lower interest rate. This in turn will also help the PE ratio on these companies and their stocks, which means companies will have stocks that are worth more money, more valuable, and which means people are going to buy them more. There's going to be more value in them, which means more investments, more growth. It's a residual circle that's going to continue and evolve full circle. This is what happens in the stock market. As you cut rates, money gets cheaper, borrowing gets easier, profits get easier, PE ratios start to go down, which is good for the stock market. And not only that, it pulls certain aspects of the economy out of a recession that's still somewhat in recession. Auto, due to insurance, homeowners insurance, the housing market in general, and durables are kind of not doing as well as services. Services are doing great in PMI. Manufacturing is slightly contracted and kind of stalemated in one spot. It's kind of consolidating. However, services is expanding, which is good. I guess you could say a different market than it was pre-COVID. This is completely different. So with all of that being said, and the issue of the elections, there's volatility. Once the elections are over and we see what the PMI data is for the first week in November, which is right before the elections, we're going to have that, then the elections. If all is good, payroll is good, then we're going to be good after the elections. Everything should be solid. It'll stabilize as we go through November. Things will get better in the stock market. It'll get really bullish in December like it usually does, just based off of history. That's what usually happens. And with the election out of the way and with good PMI data, we have good chances for better earnings. Interest rate cuts will only help this. And then we have more PMI data coming out again the first week of December. So if we have November and December, good PMI data, once the elections are over, we have a good shot, especially with another 50 basis points cut in order to make the economy really strong going into January. There is that potential and the market could run pretty strong. And in my opinion, right now, that's the likelihood. I mean, I've really been on the $580 train for SPY since back in January or February, and even higher. I actually was thinking more like 590 to 600. Looks like that's going to be a possibility, but you have to really watch what you're doing between now and the elections. I highly suggest, and I really do, I care about you guys. I don't want you to lose any money. I highly suggest being careful with stocks that you're up right now and you're in a profit. If you're running the wheel, the strategy on these stocks, or you're just holding shares for profits, if you're in a profit position right now and it looks like you could get out or there's a ceiling, maybe sell some shares, sell some percentages, keep a cash position, because when the stock market does have some form of pullback somewhere, you'll be able to buy some dips, add to your position other stocks that are more likely to grow. You really have to look through and make sure you've got really good positions and trim them up and have some form of a cash position right now, just in case there is some dips happening. As I said in my previous video, hedge funds and institutions were underinvested, which means they're now consistently investing daily and weekly over time, which is keeping the market going up. So there is also the chance that the market pullback may not happen, or it may happen very softly, and it may be somewhat unnoticeable depending on the stock. It's very, very difficult time in the market. Do your diligence and pay attention and have some form of cash position. But ultimately, my recommendations right now between now and the elections is to buy the dip, dollar cost average as things pull back. If they don't pull back going into elections, you can slowly add. And if things look like they're moving up leading into the election, you can start adding back into your positions, but you have to play it safe. Tom Lee basically said the same thing. And I do agree with most of what he says, not everything, but most of the things that he says. And right now we're in a pretty decent spot, even with the headwinds of the election. So ultimately, you just have to take care of your portfolio, protect it, have some form of cash position. This way, you'll be able to buy the dip, add to your portfolio. And I think going into the end of the year, all of us are really going to be in a good position, as I think we're all in store for a pretty surprisingly strong bullish run after the election. Don't forget, if you want to take control of your financial freedom, I would love to help you guys. It's what drives me every single day. You can see the profits my students are making on the screen right now. I offer full Discord, training course, and one-on-one coaching. The link is in the information box below, investwithcorey.com. I would love to help you, fam. Whenever you're ready, book a call with us. I look forward to seeing and helping you grow your portfolio. Thanks so much, guys, for being here. I really appreciate it. I'll catch you on the next one.